how are you going to survive as a real estate investor, specifically a rental property investor, in a crash or in a recession? This question comes up a lot, especially in times like today. This is currently August 2020, and as we all know about 2020, it's the year of COVID, and our country is hitting a recession. So, people ask like, well, how can I recession proof my properties? Or how am I going to survive a crash? Or, what's going to happen? And the first thing to understand is that in a crash, there's a lot of emotions. It's scary. Jobs are on the line. All sorts of stuff is going on. But as an investor, one of the best things you can do is just pause and calm down for a second. And the nice thing about real estate is you have options. So, you want to be smart on those options. So in terms of crash survival, if that's what you want to call it, I think the answer to that primarily lies in the purchase of the property. So when you go to buy a rental property for an investment, always think, what's going to happen if there's a recession or a crash in the market? So buy your properties with that in mind, because there's certain dynamics that matter. For instance, one of the biggest ones, if you buy a cash flowing rental property in a strong market, so you're making money, you're making cash flow every month, the city that you bought in or the bigger city that you're near continues to grow, there's lots of industry, lots of jobs. In that case, you're investing for cash flow. You're not relying solely on appreciation for profit. This is a huge distinction. So in the time of a crash, if that happens on your cash flowing rental property, it's possible that nothing changes for you. The tenant continues to pay the exact same rent that they were. The value of your house, even if the value of your house goes completely underwater, the value of your house, and this is so important for this whole video, for every investor to understand, and quite frankly, for every homeowner to understand, the value of your property does not matter unless you're trying to sell it or refinance it. If you're just holding the property, it could go to $0 worth, and that doesn't matter as long as you're not trying to sell it. So, the primary home buyer thing, especially in 2008, so many primary home buyers freaked at the recession, and they just sold their house at like a 2/3 loss or something. And it's like, hang on. Now, some people needed to because they lost their jobs or whatever, but a lot of people just did it out of panic. And it's like, they hear that the value of their house is now, a third or a half of what it was before, and they freak out, so they sell. Well, that's the worst thing you can do. As we all know, there's ebbs and flows in the real estate market, and if you can just wait it out, the value will come back at some point. Like, don't worry about it. Don't freaking sell, because then you've just made your worst nightmare happen. Exactly what you feared is now what happened. So let me get off that soapbox and tie that back into what I was saying. So if you, as a rental property investor, buy a rental property that is cash flowing every month, meaning your expenses do not supersede your income, so you have extra money in your pocket every month, and you buy a property with strong, it's in a market with strong fundamentals and all that kind of stuff, the only thing changing in the recession for the time being is the value of the property. Well, keep your cash flowing tenant in there, and literally nothing's changed other than the value of your property. But again, that doesn't matter. That's in contrast to if you go buy a rental property, let's say it either breaks even every month or it has negative cash flow, but your sole intention with this rental property is profiting via appreciation. Well, appreciation is speculation. And ask all the speculators how they felt in 2008 and 2009. Well, when they were relying on appreciation or the increase in value of their property for their income, and suddenly their property is worth like a third or a half or whatever it was, well, that's a problem. And, if they were planning to only hold it for like 2 or 3 years, well, guess what? The crash lasted longer than that. You can look at the example of a house flipper. Let's say a house flipper buys a property in January and the intention is to flip it for profit in August. Totally normal. Well, our recession and the crash in 2008 happened almost overnight. So what happens if that crash happens in July And now you have this property that you were trying to flip, and a flip is completely based on the value of the property. And now the value of the property is in the toilet because now we're in a recession. So I don't say any of that to scare anyone, but I do say it to anytime you're going to start into a real estate investment, any kind of property, you need to understand where the risks are. And one of those categories of risk are crash. What's the risk in a crash? Okay, so I'm going to go flip a property. I'm buying it in January. I don't know, worst case scenario, let's say there's a total and utter crash in July, and I was going to offload it in August. Well, I need to be aware of that risk. The good news is most of the time you're not going to have that big of a crash, and that, the odds of that happening are pretty slim. But now we have two major things that have kind of happened. The 2008 crash just tormented the speculators who were hoping for appreciation. And now in 2020, we have COVID. Interestingly enough, COVID, the prices are continuing to rise. And the anticipation is that there's not going to be a drop in housing prices. Fun fact, of the last 5 recessions, including the Great Depression, housing prices only dropped in one of them. And that was the 2008 crash, because that whole crash was based on the mortgage industry. Fun fact, don't know if you know that. But either way, COVID has made a big impact on just dynamics of things this year, and it's not over. We don't know a year from now and 2 years from now and 3 years from now what the impact's going to be. So things do happen. Like I said, it's not likely that there's going to be a crash right smack in the middle of your flipping project or whatever, but you want to at least be aware of that. So it's like, okay, well, let's say that there's a crash. Could I potentially rent that property out and hold it until the value comes back? That's flipping. But going back to rental properties is, like I said, the best way to survive a crash as a rental property owner is to be smart when you buy the property. Buy it with solid cash flow. Buy it in somewhere where there is a lot of industry and jobs, so that if there is a crash, you're not going to end up in a Detroit situation where the entire city goes completely bunk. So, Atlanta's one of my, not so much now, but one of my favorite markets. There's so much industry in Atlanta that even if a couple major industry players went out for some reason because of a crash or recession or whatever, you have a lot of other industry players there to continue providing tenants, to continue growing the city, to continue contributing to population growth. So again, in that case, you end up as a cash flowing rental property investor with potentially zero impact during a recession. That's huge. That is absolutely plausible. I know tons of people in 2008 that just kept on business as usual with the rental properties because there was solid cash flow, they had solid tenants, the market, the city itself didn't crash. So if, the management when the crash happens is going to be based on what it is you bought in the first place. So really going into a rental property investment, understand what factors about it contribute to what, and hypothetically, run the hypothetical. If there's a crash, what happens? So it's a good question to ask. It's a good exercise. It's part of your due diligence, learning to be a really good investor. Learn the answers to these questions, because then when you know them, you're that much more powerful with your investment. And then should something happen, you have that much more control over what to potentially do about it, because you know what tools are in your tool belt and you know what things impact another. So you can make smart decisions and do the best that you can.